Hello, and welcome back to Private Markets 360, S&P Global's podcast dedicated to enlightening and educating our listeners about the world of private markets from vast vantage points. Your Private Markets 360 co-hosts both sit within market intelligence. I'll start off with introductions. I'm Jocelyn Lewis, head of private debt commercial strategy.
And I'm Jocelyn's co-host, Chris Sparenberg, head of private markets commercial strategy. I'm a super fan of our corner of the investment industry. We're thrilled to bring our listeners exciting guests every month for discussions about industry trends and other topics of interest here on the podcast.
We sure are, Chris. And if you're interested in regular private markets content, hit subscribe and tune in. Ready to introduce our guest, Chris?
Let's do it. Welcome to Private Markets 360, your insider's guide to the world of private investments. Today, we're joined by the CIO of GLASfunds, Brett Hillard. GLASfunds is a leading alternatives investment and operational platform, providing financial advisors with direct access to exclusive private opportunities. With a wealth of experience in the financial industry spanning over 15 years, Brett has been at the forefront of integrating private markets into the registered investment advisor space. His strategic insights and innovative approach have helped shape the investment landscape, making private alternatives more accessible to a broader range of investors. Brett, welcome to Private Markets 360, and thank you for joining us. How are you today?
I'm doing well. Thanks, Chris, and happy to be here.
Awesome. Well, we're super excited to have you today, Brett. And to start off, would you just please provide an overview of GLASfunds and its mission?
Yes. So GLASfunds, we're an alternatives platform. We work with financial advisor firms, mostly RIAs and private banks, to help them implement and scale their alternatives platforms across mostly ultra-high net worth individuals as well as smaller institutions. Wealth managers need a lot of tools to implement a robust alternatives and mostly private capital program. They could be managing hundreds, if not thousands, of individual portfolios, and the goal is to build diversified portfolios within each client book. And it can quickly become administratively complex, as if each client owns 10 to 20 different underlying positions across hundreds, if not thousands of clients, wealth management firms need a lot of tools to help them do that efficiently and cost effectively. So we provide a number of services to help them implement and scale, as well as provide a curated list of best ideas across hedge and private capital to supplement our wealth managers' due diligence efforts.
I can see how having that additional information as well as a platform to centralize all the information would be really helpful. And one of the things I'm curious about is how GLASfunds differentiates from more of the traditional investment platforms.
Yeah, there's several larger differences. One is in how we go about aggregation. We do not spin up new feeder funds per underlying fund that we're trying to provide exposure to. We've designed and managed two legal structures that can more easily provide access to underlying funds. We can aggregate for as little as $1 million, where if you're spinning up a feeder fund, probably need at least $30 million to spread out the startup costs and the operating expenses early in the fund's life. As I mentioned, we can do that for as little as $1 million, and then we can have a much quicker time to market. And that's becoming increasingly important with more time-sensitive allocations. You know, a good example are direct co-investments, where the turnaround time to decide on allocating can be measured in weeks as opposed to months or quarters. And there's a number of other efficiencies by aggregating within less legal structures. We can provide aggregated reporting, aggregated tax reporting. For example, a underlying client can own 20 different positions. They'll get a single aggregated federal K-1. And then we'll also work with our auditor and tax partner, PwC, to help them with the increasingly complex state K-1 tax filings. These are some of the main benefits. There's a number of others, but these types of efficiencies are increasingly important as the penetration of alternatives becomes more mature across the wealth management firms.
It's a really unique structure. And on that topic, I'd like to talk a bit more about fund structure and implementation. Could you take us through kind of in a deeper way the structure of the GLASfunds and how you obtain access to private investments that you're offering to your clients?
Yeah, so we've created and managed two legal structures, an onshore, offshore, that exists for different tax situations for different types of investors. And when we look to onboard a new fund with a new manager, that fund or manager just becomes a series within one or both of those legal entities. And we've spent 15 years iterating on the structure, working with top tier law firms and top tier service providers to make sure that the assets are legally walled off per fund and per manager and per account. That has to be absolute. And then also it requires a pretty sophisticated program in terms of sub-accounting. And with GLASfunds being incepted the tail end of 2008, we've worked through the years to iterate these two key features that has led to the differentiated legal structure. So we can quickly onboard a fund. We'll do operational overviews. If the GLAS research team is underwriting it, we'll do a full, extensive investment due diligence process. If one of our advisor firms is sourcing the idea and just using the GLASfunds architecture, the research team will do a quick overview. And if that passes the overview, then we can onboard the fund. And from the perception of the GP, we're just another LP coming into the fund. If the GP didn't know what GLASfunds did, we would just look like another either multifamily office institutional investor coming into one or both of their underlying fund structures.
Understood. And then ultimately, with how that's implemented at the wealth owner or end client level, can you give us a sense of how you work through the RIAs to support the fund selection process, the allocation, just a little bit more on the end client's experience?
Yeah, so we work primarily through the advisor channel. So advisors can utilize GLASfunds in several different ways. We have some advisors where they're sourcing and diligencing all of their own ideas, and they're using the GLASfunds infrastructure and technology to scale that across their book of business. So they have the flexibility to do that. And again, because we're not setting up new legal structures, we can aggregate for as little as $1 million, and there's no startup costs, and the time to market is much quicker. And there are a number of sophisticated wealth management firms out there that have experience in sourcing and diligencing alternative funds. And when they want to allocate, it could be for $5 to $15 million in total. Well, that's not going to justify spinning up a new feeder fund. But then for diversification purposes across their ultra high net worth book, they need to allocate, and sometimes in as little as $100,000 underlying tickets. So our architecture can help them facilitate that. And then we have other advisor firms that either have decided not to really focus on manager sourcing and due diligence, or they're newer to the space and want to supplement their efforts with the research that the GLASfunds teams does. And they can select funds off our curated lists to implement across their client books as well. So we have a whole mix of different advisor firms. We have some that source 100% of their own ideas. We have some where it's more of a balance. They do some of their own sourcing. They utilize our list to supplement it. And then we have some advisors that pretty much rely on our sourcing and due diligence capabilities.
That sounds pretty unique, how you have all these different types of offerings. So whether you're providing that technology infrastructure, or you're providing kind of that curated list of types of funds to invest in, sounds like there's different ways in which you work with the RIA market. So could you dig in a little bit more to provide more context about the value add and the solutions that you're providing to your clients?
Sure. So previous to joining GLASfunds, I was at a regional private bank and helped them implement their private capital platform within their family wealth unit. And we quickly realized that going direct to funds was problematic from an administrative perspective, because financial advisors had to comb through 150-page plus subscription documents. They had to execute those docs, do the wires, do the capital calls, distributions, raise the liquidity, et cetera, et cetera. And then we decided to pivot and happened to decide to work with GLASfunds. And we were able to implement the program across dozens of clients. It ultimately reached in the hundreds of millions of dollars of total allocations. And the first users at the time I left, they started to have 10, 15 positions in their portfolios. We were able to do that with a very limited number of dedicated administrative professionals. And that's very important within the wealth management framework is, yes, there is a benefit of incorporating alternatives into client portfolios. There's a competitive need to do so. However, wealth managers don't want to have to dedicate too many resources to the administration of their investments because that's not really their competitive advantage. Their competitive advantage is financial planning, client relationships, portfolio construction, investment selection, et cetera, et cetera. Administration is really not a core competency. It's something that's necessary, but they want to do it in a scaled fashion that's very cost effective. Also, we quickly realized that there were only a select group of funds that were going to take direct tickets as little as $250,000. And to really unlock the entire ecosystem, we had to be able to aggregate to unlock all of the ideas across either hedge funds and private capital. Now, this was a number of years ago. This was before really evergreen funds have become increasingly popular. So there has been some development and advances where there are a number of different options now for wealth managers to allocate different types of private capital portfolios in different types of structures and being able to evaluate the cost benefits of doing it a number of different ways. But just wanted to highlight my experience on the wealth management side to show how some of our services and technologies and infrastructure can really help a wealth manager from a competitive position as well as from a cost perspective and being able to implement these platforms.
We can certainly relate with that because we have a number of software and services in different arenas at S&P. But when you made the point of how your clients, they really want to focus on what they're good at, and that is selecting the right investments, helping their clients that way, the relationship management, absolutely. Put that with them. That's what they're good at. And you've found that way to really provide that administration that's really so valuable. So we can really relate with that. So thank you for sharing. And another question that we have is we've both just spent a lot of time at conferences and we've heard a lot of managers talk about their portfolios and how resilient they are. But I want to know from your perspective, how you identify the managers that you have the strongest confidence in.
Yes. So we take a bottom-up approach. We try to limit the amount of top-down calls that we make. And it's really just increasing the amount of at-bats. I think making big macro or sector calls, at least for me, has been difficult. And if underlying fund decisions are made by a top-level macro call, if you happen to get that macro call wrong, there's a lot of downstream impacts to that. So we take a bottom-up approach and across either hedge, buyout, credit, real estate, or other type strategies, we try to identify managers that have a demonstrated competitive advantage in whatever vertical they're focused on. And we break down their strategies into their component parts. For buyout, it will be at the individual company level, credit, the individual loan level, real estate, individual property level. And we want to look for the key decision makers, as broad of a track record as possible, and be able to identify a degree of consistency of generating attractive returns without taking undue risks. And we apply this approach across the different strategies. And we also try to squeeze out what was market-driven versus what was manager-driven. Was the manager in the right sector at the right time and has generated good absolute returns, but when you compare it to other managers in that sector or very similar strategy, the manager's performance is not as intriguing as it initially looked. So those are just some of the examples of how we employ this approach to identify best-in-class managers that have a distinctive competitive advantage. The firm is structured in a way, the team is incented in a certain way where we can realistically apply strong probabilities of that team being able to execute that differentiated strategy on a go-forward basis. I would also say we tend to lean a little bit more towards smaller or medium-sized managers as opposed to large managers. Now, we do find large managers to be very competitive in certain types of strategies, and certainly have in the past and will continue to recommend strategies of larger managers. But we've found a little more differentiation and competitive advantages with some smaller, more focused managers that have the potential to deliver some compelling risk-adjusted returns compared to more high-capacity strategies.
And there's some interesting quantitative research out there supporting that, right? Some of the lower middle market sector specialists just outperforming in general their larger peers who have a more generalist approach.
Yeah, and I think in a number of areas it makes sense. They know the market players more. They potentially have been working on compelling transactions for a number of years versus generalists who may be entering into a market more recently. They may have better sensitivities on all the industry dynamics and if certain changes are going to happen, how that's going to impact all the players. We certainly see a number of areas where that is the case. However, there are instances where having scale can be a competitive advantage. In certain areas of private credit, we think scale can be advantageous. It can lead to better financing terms on the private credit originator's cost of capital. It can lead to better deal flow because the borrowers need a surety of close, or the borrowers need certain hold sizes to make it work, and then the lenders can get better terms. So I would say it's a general rule. We just don't follow it absolutely, and we try to identify markets where having a little more focus can lead to better results versus where having scale can be advantageous as well.
So it sounds like you must be reviewing tons of information. And I'm curious what trends you're seeing across some of the core strategies that you're providing access to retail investors. And also curious how the different strategies compare and contrast in terms of the type of information that's available and how you compete or work with the funds that have some of their own distribution networks, as I would think that might be a little challenging.
Yeah, so one trend we see is in certain high capacity, more liquid type strategies. So think middle market direct lending, core plus real estate, buyout secondary funds. Those types of strategies are increasingly being penetrated with evergreen funds. And those strategies, based on their duration and liquidity, also may make a little more sense in evergreen funds as well. So one takeaway from that trend is, while we never say never, the bar is very high for us to underwrite and recommend a drawdown fund structure within a large cap middle market direct lending strategy. We think that sort of core allocation, there are a number of other different access points versus a drawdown. However, we can take advantage of new fund structures being raised because there's been a number of new private credit managers and existing private credit managers are looking to raise capital within evergreen funds, and they want to go to market with scale. So we've recommended a number of anchor deals within new evergreen private credit funds, where if we're part of the anchor capital that seeds this new fund, we can receive a package of economics that typically includes lower management fees and incentive fees, as well as some sort of revenue or profit share, either into perpetuity or for a set number of years. That is a very strong value proposition because for attractive underlying exposure, we can potentially enhance returns anywhere from 200 basis points to 500 basis points per year. And our clients gain the advantage where if they aggregate in a drawdown fund and write a single big ticket to that GP, they're rewarded with those economics. So that's an example of, some of these trends, what that has led us to sort of pivot to on the type of strategies that we're looking to offer. Yes, as with us being an intermediary, we do see a lot of manager and deal flow across our desks. We're working now with close to 150 advisor firms. A number of those advisor firms are sourcing their own ideas, and those are all crossing the research team's desks. and that can be a unique source of manager flow. Now, to be clear, we never want to take an idea of one of our clients and run with it. So if we find something interesting, we'll reach out to our sourcing advisor and ask them, hey, are there any sensitivities? Are there any capacity sensitivities around this manager? Any competitive sensitivities? Many times there's not. And then so we'll start diving into that manager on a more detailed basis. And that has led to several compelling ideas being approved for the broader platform.
Can we dive into some of that deal flow that's crossing your desk? We've spoken a little bit about private credit, but what other areas of the market are you finding compelling? What are the interesting things being surfaced by some of your member RIAs or your client RIAs?
Yeah, so we've identified a number of specialist real estate managers that have organized their business in a way that we think accretes value to the LPs. So we recently approved a workforce multifamily developer that's fully vertically integrated, and they focus on multifamily developments in the Southeast. And their full vertical integration to property design, construction, material sourcing, leasing, etc., passes through to the end LP. So it takes out a number of the JV partners that will get either promote on the deal. They've built out sophisticated supply chains where for their materials and their developments, they're actually buying materials directly from factories overseas. So they're able to cut out the wholesaler profit margin. And, in some instances, they're able to buy these supplies at 50 cents on the dollar versus if they went through a wholesaler in the US. So we found a number of these types of real estate specialists focused on attractive areas in the US that have a demographic and income tailwind to them and have been able to push through the interest rate volatility that we've seen over the last number of years. Now, to be clear, we're not making interest rate calls. We're looking for areas in real estate market that have the secular tailwinds behind them that it can push through higher interest rates. But we are aware that most likely interest rates have plateaued. They could be on the way down, and that would just be an additional tailwind to the strategy, which we think could perform well regardless of the interest rate environment. Another example is data centers. This is well known, this opportunity exists, but the demand in hyperscale data centers is just overwhelming. There has been a sharp supply response, but that supply response still has not been high enough to satisfy all of the demand. And we're focused on managers and developers that have been able to de-risk some of the key bottlenecks, which include procurement of power, procurement of electrical equipment, acquisition of land and zoning in top-tier data center markets. So that's another area where we think, at least for the next several years, could be pretty attractive.
Can you talk about some of the dynamics involved in when ideas go the other way? So when you've sourced an idea, you've underwritten something and have conviction, and you have to work through the RIAs to ultimately explain the opportunity to their end clients. What does that process look like, and how may it have changed over the recent past?
Yeah, that is a more complex part of our business because we are working through the senior leaders of the advisor firm. Then the advisor firm is democratizing that idea to their advisors, and the advisors are educating the clients. So there's multiple rungs within that chain. How we have to do it is just really consistent dialogue and communication and seeking feedback from our advisor firms, where we can get some critical mass on some feedback of saying, okay, well, there's an interest in this type of private credit, so let's explore some interesting ideas in this ecosystem. We've gotten better at it over the years. There's certainly been some instances where we have found some compelling ideas that just didn't resonate with our client base. And, the takeaways from that are just beforehand, what could we have done to sort of get that feedback? It doesn't serve anyone any good of us just doing intellectual exercises and researching some really interesting ideas. They're just ultimately, at the end of the day, they don't get implemented. So we've really increased our coordination with our business development team who are interacting with the advisors on a daily basis to get two-way information flow on what could potentially be compelling for their client base.
Given the demand from the RIA community for access to private markets, for those who are interested in learning more about accessing it, how should they go about, finding opportunities?
Yeah, there's a plethora of information. I mean, the democratization of alternatives has been a multi-year trend now, and there are a number of good information sources out there. Some of the large private capital managers have built out entire education sections, and they can help provide a fundamental base. GLASfunds, we've also written a number of pieces that we've posted to our website where advisor firms can access that. And increasingly, there is more transparency on underlying type strategies with more evergreen funds that are ultimately registered and have broader accessibility. More of that information is readily available. I will say for strategies that will likely remain in drawdown fund structures and truly private, that information still is a little more complicated to obtain. There still is a degree of having to have relationships and having the ability to source managers, doing a number of manager communications to start building up a base of information on certain strategies and certain key players and verticals. I think that will always exist, but with the increasing demand for broader access to alternatives, there has been sharp growth in the information that's just readily available online and through various, like I said, large private capital managers.
And when it comes to measuring, comparative performance, what are the market data sources or benchmarks that GLASfunds are using and potentially other RIAs and ultra high net worth investors?
Yeah, so we look at performance several different ways. We look at it versus a public market equivalent. So a common way we measure private credit funds that we've recommended is if they didn't decide to invest in this private credit fund, what is a comparable public market equivalent where they could have invested? And we measure that based off a leveraged loan B-rated index. And so we'll compare the performance of the private credit fund versus a leveraged loan B-rated index over a similar time period. We'll also compare private funds based on their vintage year, based on peer groups as well. We rely on Hamilton Lane benchmarking data. And, for example, for a 2021 senior lending direct origination credit fund, we'll go through the Hamilton Lane database and build a peer group and compare how the fund that we recommended compares to the peer group. And so those are, on top of obviously reporting the absolute performance, we look at relative performance on two different ways. One is, many advisors are deciding, do I just want to stick with liquid markets? And if I did, what is a comparable risk exposure? And then if I go private, how do I know this manager is performing well versus its private peers? And those are the two ways that we try to communicate that information to our advisor firms.
Understood. And I think it is, extraordinarily helpful, especially for high net worth investors who are still going to be disproportionately exposed to public markets, to have that public market equivalent for more of an apples to apples comparison. But on that topic, and as we think about the increased involvement of high net worth investors, the opening of this opportunity in private markets to retail investors, I'd love to close things out by just asking for your thoughts on the future here. If we look out, the next 10 to 15 years, what are your thoughts on how the landscape will change, the involvement that retail investors will have in more funds? Just curious to understand the perspective from GLASfunds.
Yeah, so our view today is we think evergreens are continue to grow in certain areas. We think credit, core plus real estate, high capacity, lower duration private equity strategies like secondaries, perhaps co-investment. We think over time, more of the total AUM in those verticals are going to be managed in evergreen funds. And those are going to be more broadly accessible to a wide range of client types. There's also predictions that these funds will ultimately make their way into 401k plans. Certainly, I think some of the development of the evergreen funds are with that view in mind of, having attractive vehicles that could fit within 401k plans if the regulatory environment would allow them to do so. We also think some strategies will continue to remain in drawdown funds, and investors that need easier implementation, they want scaled access for a broad range of client types, more core-like exposure, they're going to fully utilize evergreens. But there are some things that most likely will never make sense within an evergreen structure for a whole host of reasons. And we think there's sort of going to be a barbell. I mentioned previously, the bar would be very high for us to recommend a senior lending drawdown fund versus just recommending an evergreen. And we think that could happen within private equity secondaries as well. But where we think investors will be able to achieve more differentiated are in smaller, medium-sized managers that are focused on very specific areas of the market. And we also think scaled allocators, and we see it today with our larger, more mature allocators, are developing co-investment programs where they'll establish relationships with a manager, agree to commit to a certain size to the commingled fund, and then get a ratio of co-investments. Those individual co-investments are most likely going to still reside in drawdown funds. And I also think ultra-high net worth individuals are going to increasingly demand more differentiated exposure into direct companies, whether it be buyout companies, growth companies, venture capital, et cetera. I think the demand for co-investment is going to rise. And I also think a dedicated secondaries market catered to the wealth management channel is going to develop and become increasingly larger and account for a material portion of the total secondaries market. If you look at the secondaries market today, the vast majority of it is dominated by institutional flow or sovereign wealth funds, other types of institutions. It's more challenging to do secondaries within wealth management because it requires a decent amount of diligence, legal work to transact in much smaller tickets. But there needs to be solutions that open up to be able to provide the secondary liquidity that will there will be increasing demand from wealth management investors for secondary market liquidity, and it will probably follow a similar path to what we've seen on the institutional side. So those are a couple of larger trends that we've been discussing internally and trying to position GLASfunds to offer compelling opportunities across all those different trends going forward.
It's really interesting to compare it to the evolution of institutional, where you start with a diversified multi-fund vehicle, you move into direct manager allocations, you then kind of branch into co-investments and ultimately directs. I think you're right. There's a lot of market infrastructure that needs to exist to realize that ultimate end goal, but we'll be curious and very closely following those trends over the next few years.
Yeah, absolutely.
Thank you so much, Brett.
Yeah, thank you, Chris and Jocelyn. Really appreciated all the thoughtful questions and enjoyed the conversation today.
Thank you for joining us for this episode of Private Markets 360, where we explored the transformative role of private markets in wealth management with Brett Hillard of GLASfunds. Brett provided invaluable insights into how RIAs can leverage alternative investments to enhance their offerings and cater to the evolving needs of their clients. As we've learned, the landscape of private markets is rapidly changing, making access more feasible for a broader range of investors across a diverse base of private markets strategies. And we will continue to see the effect of retail capital accessing private markets over the coming years through platforms such as GLASfunds. We appreciate you tuning in and hope you found this discussion enlightening. Don't forget to subscribe to Private Markets 360 for more expert insights and trends in the world of private investments. Until next time, have a great day.
Thank you again to our wonderful guest for a great chat today. We really appreciate everyone listening in. If you're looking for more private markets content, hit subscribe to catch future episodes and listen to our earlier episodes wherever you listen to podcasts. Cheers, everyone.
Thank you so much. You can also subscribe to our monthly Private Markets 360 newsletter. The link is in each episode bio, or connect with us on LinkedIn. Have a great day.